Wait a minute, what am I looking at?
I need you guys to come back up here.
There are three ways to make a living in this business. Be first, be smarter, or cheat.
Don't even think about me on this. We're going down.
In this reaction video, I'll break down and explain the core financial concepts in the Margin Call movie based on my work experience at Goldman Sachs in New York City and at the top hedge funds in the world. I'll also teach you many finance concepts from the movie, especially how leverage and margin can destroy your net worth as an investor if you're not careful. Now, please stick around because at the end of this video, I will grade the movie for Wall Street realism with a buy, hold, or sell rating. Let's begin. Now, the company in this movie represents an investment bank very similar to Lehman Brothers, which went bankrupt in 2008. And this is their trading floor, which accurately shows what trading floors look like for an investment bank. And these are the main characters here in the movie and their functions in the investment bank, which I'll explain in a lot of detail in this video. We'll come back to these characters, especially the CEO, whose name is John Tull, a name similar to Dick Fuld, who is the CEO of Lehman Brothers. And this movie takes place in one crazy day in 2008 when we were within 24 hours of bank machines not working in any country. And early on in the movie, Eric Dale, the head of risk management, gets fired.
Look, I run risk management. I don't really see how that's a natural place to start cutting
We hope
jobs.
you understand this is in no way personal. The majority of this floor is being let go today.
Now, risk management is a job function that makes sure that the company won't lose too much money if they own too much of a certain stock or asset, or if they use too much leverage, meaning borrowing money to invest. And for your personal portfolio from a risk management perspective, if you buy stocks, I humbly recommend that no stock is more than 5% of your portfolio and no more than 20% of your portfolio is exposed to a single sector like technology, healthcare, financial, cyclicals, and other sectors. Now let's see what kind of a severance package Eric Dale gets.
The firm is offering you 6 months severance at half your salary. You will keep all unvested options that you currently hold.
Now here Human Resources talks about unvested options. Now stock options are a form of pay. They let an employee buy company stock in the future at a set price. Now, unvested means it's not fully earned yet. It usually becomes yours over time. And she's telling Eric, played by Stanley Tucci, he won't lose those stock options even though he's being fired. And they're letting him keep those potential shares as part of his severance so he doesn't walk away empty-handed and so he doesn't call the media or regulators to complain about what he is uncovering in this movie. Now, as we can see here, when Eric was fired, he gave a thumb drive to a risk management associate. And in the next scene, we see the associate explaining what disastrous information was on the drive to the head of trading.
This is basically everything that we have in our books at any given time. But what Eric was trying to do was to work these numbers for levels of volatility that fall outside of the standard VAR model.
Now, volatility means how much the price or value of something swings around. If something's highly volatile, its value goes up and down a lot, and an increase in volatility means risk. And here the risk management associate found that the firm's risk model could not handle extreme volatility, and he mentions a standard VAR model. Now, VAR stands for value at risk, a tool that banks use to estimate how much they could lose on a bad day. And high volatility outside the model's range means the firm could lose way more money than they thought possible. And they realize how screwed their investment is. So they schedule an emergency meeting with the CEO and senior executives.
Maybe you could tell me what you think is going on here. And please, speak as you might to a young child or a golden retriever. It wasn't brains that got me here, I can assure you of that.
So CEO John Tull opens an emergency meeting with humor and humility, asking for plain English. Now, in high finance, concepts can get really complicated. Even the CEO needs them broken down clearly. Now, Tull jokingly claims that it wasn't brains that got him to the top, implying that success on Wall Street isn't just about IQ. It's about politics, decision-making, and trusting your team's expertise. But the reality is, he knows exactly what is going on, and he wants to fire somebody in the boardroom who heads up risk in the bank. And here, a more junior risk management associate explains what exactly is going on.
If those assets decrease by just 25% and remain on our books, that loss would be greater than the current market capitalization of this entire company.
Now, the senior risk associate delivers this gut punch. A 25% decline in those assets values would wipe out the firm. Now, market capitalization means the total value of a company's shares, basically what the company is worth according to the stock market. And he's saying that the loss from a mere 25% decline in the mortgage assets would be more than the entire company's worth. And so in plain English, a 25% dip would cost us more money than our entire company is valued at. Also note, remaining on our books means if they keep those assets and take the hit internally, as opposed to selling them, this highlights how insanely overextended they are. And it's a dire warning that they're on the brink of collapse. And the risk management associate follows up with this.
These are essentially just mortgages, so that has allowed us to push the leverage considerably beyond what you might be willing or allowed to do in any other circumstance, thereby pushing the risk profile without raising any red flags.
Now, he starts explaining that the troublesome assets actually are mortgages. And here, many mortgages were bundled together into investments. And because those assets seemed very safe, the firm took on huge leverage against them. And leverage means borrowing money to invest more. It's like investing $1 of your own money and borrowing $9 more to buy something worth 10 bucks. It's great when prices rise, but it's terrible when they fall. And he's implying that we piled on debt because we thought these mortgage assets could not fail, and they pushed leverage beyond normal limits. Now, by levering up so much, they made the risk profile extremely high without anybody raising alarms. And in short, the firm was over-levered, meaning they had too much debt because they believed these mortgage-based investments were sure bets. Now, here is the CEO's response.
The music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism.
He's such a brilliant actor. But here, Told uses a musical chairs metaphor to grasp a looming crisis. The music is about to stop means the good times in the market are ending. And in finance, that translates to being caught with toxic assets that nobody wants. And the bag of odorous excrement is a crude image for those worthless investments that the firm might be stuck with. And CEOs get to the top, not only because they can play politics, but also because they can explain really complex concepts in simple terms. And this is an extremely valuable skill in business. And in simple terms, he's realizing that if they don't act quickly, the company will hold a pile of bad assets that could ruin them. And this clip introduces the concept of systemic risk, meaning when markets collapse, this can leave even big banks holding worthless stuff. And CEOs and senior executives make the big bucks often because of one or two decisions that they make each day and their ability to predict the future.
I'm here for one reason and one reason alone. I'm here to guess what the music might do a week, a month, a year from now. I don't hear a thing.
So in this chilling moment, Tull defines his role as CEO, meaning guess what the music, meaning market, will do in the near future. So in other words, his primary job is forecasting or anticipating market changes to protect the firm. And when he doesn't hear a thing, it means his best prediction is that a market crash is imminent. The music of market activity might stop entirely. And this is a stark admission of uncertainty and fear from the top boss. Now, for a beginner, the key takeaway is that a CEO of an investment bank is essentially a chief risk manager. They're paid the big bucks to hear trouble ahead. And Tull's metaphor of not hearing anything signifies that all signals point to a severe halt in normal trading and a crisis scenario. And it's a really dramatic way to show how even leaders can be alarmed when data predicts disaster. And this really teaches us about risk management. Even the head of the firm must make very tough calls based on predictions. And sometimes those predictions are dire. So what should he do?
There are three ways to make a living in this business. Be first, be smarter, or cheat. It sure is a hell of a lot easier to just be first.
Sell it all today.
Now, this is one of John Todd's most famous lines. He bluntly outlines the Wall Street playbook for success: speed, smarts, or dishonesty. Be first means act before others. For example, sell off bad assets before everybody else realizes that they're bad. Be smarter means outthink the competition, have better analysis or insight, or cheat, which is self-explanatory. But he says it's a hell of a lot easier to just be first. And this reveals a key concept: first mover advantage. In a panic market, the first seller often gains the advantage, getting out before others before prices plummet. Quick side note: Goldman Sachs was one of the first sellers prior to the great financial crisis of 2008, and clearly not Lehman Brothers. Now, the ethical note here is subtle. He claims not to cheat as he wants to be first. Yet the solution that he's pushing, dumping toxic assets on unaware buyers, really feels like cheating, even if it's technically legal. And Todd's right-hand man, Cohen, said, "Sell it all today." And this clip shows the cutthroat mentality in finance. Winning can come from quick action or brains, but some are tempted to win by cheating. And Todd chooses speed, highlighting that on Wall Street, quick decisions can trump even brains, but ethics could suffer. And Todd tries to imply that he is not being unethical by saying this:
We are selling to willing buyers at the current fair market price so that we may survive.
You will never sell anything to any of those people ever again.
I understand.
Now, in the early morning crisis meeting before the market opens, Todd justifies his plan to sell off the firm's toxic assets. He says they'll sell to willing buyers at the current fair market price, meaning somebody out there is still willing to pay for these assets right now, despite the pushback from his head of sales and trading. And this is basically the legal defense. If a buyer agrees to the price, it's fair, and no one is forcing the buyer, but they don't know the assets are nearly worthless. And Todd's priority is crystal clear when he adds, "so that we may survive." And the firm's survival is at stake. So he's ready to dump bad assets on clients to save the company. And this clip really raises an ethical concept of caveat emptor, meaning let the buyer beware. In theory, the buyers could do their homework, but in reality, Todd's firm has inside knowledge that these securities are junk. And selling them in a fire sale might be legal, but it's arguably very unethical. Now, for a beginner, think of it like owning a car that has bad brakes, but selling it at full price to an unsuspecting buyer because somebody is willing to pay. You get the money, they get the problem. And Todd's line really teaches us how in desperate times, companies might rationalize harmful actions by clinging to market logic, meaning a willing buyer at a fair price, and the instinct for self-preservation as well. And he further justifies his move by saying this to the head of sales and trading.
If you're the first out of the door, that's not called panicking.
Now, being the first to act is not panic. It's his cold-hearted strategy. And this line highlights the idea that in a financial crisis, speedy action can be seen as smart rather than cowardly. But to unpack this, a panic is usually irrational, sloppy, and driven by fear. But Todd implies that his decision to be first out of the door, to sell assets before others do, is calculated and rational. And he's essentially saying, I'm not panicking. I'm making the wise move before everybody else does. And this is a glimpse into how ruthless people in finance justify quick, drastic actions. It's the concept of first mover advantage again. The first person to run for the exit in a burning building is not panicking. They might just have sensed the smoke early. And Todd wants his team to see dumping the assets not as an act of fear, but as a shrewd, necessary tactic. And the lesson is this: in high-stakes situations, decisive early action can mean the difference between survival and disaster. And those who act first get to label their actions as smart, while those who hesitate might indeed panic later. Time for politics and the ruthless scapegoat strategy.
Sarah, I need a head to feed to the traders on the floor on the board.
Is it me or Cohen?
It's you.
Now, not all of Todd's tough decisions are about markets. Some are about office politics. Now, in this clip, he coldly tells senior risk executive Sarah Robertson that she's going to take the blame for the firm's crisis. He says, "I need a head to feed to the traders and the board." Translated, this means somebody high up must be fired to appease the angry employees and shareholders as well. And she realizes what he means and asks if it's between her or another executive named Cohen. And Told confirms it's you. And this is classic. This is a classic scapegoat scenario. And the concept here is that in corporate crisis, leaders often offer up an individual as the face of the blame, even if failure was systemic. And it's a way to show the company is taking action. It's like when a sports team fires the coach after a terrible season. Somebody's got to be the fall guy.
Of course, you're well aware that I filtered several warnings to you and Cohen about this a year ago.
I really don't think that's the best path for you to take. You're going to be well taken care of here.
Now, the ethical angle is that Sarah protests that she delivered warnings about these risks a year ago, implying it's not fair to pin it all on her. And Tull basically ignores that. And the lesson here is stark. In high-stakes corporate environments, accountability can be more about optics than fairness. And Tull's decision teaches about the grim side of office politics. Sometimes the solution chosen is to satisfy the crowd by sacrificing one of your own, in order to signal a fresh start or penance to those who were hurt by the firm's actions. And let's not forget that Sarah, as the chief risk officer, threw the head of risk, played by Stanley Tucci, under the bus at the beginning of the movie too by firing him. But at this point, she's powerless. And he wants her to suck it up, as she will get paid a lot of money as part of her exit package. And corporate politics can be brutal at investment banks. Now, how can the CEO convince the head of sales and trading to compromise his ethics and sell the crappy assets to his clients?
It's just money. It's made up. Pieces of paper with pictures on it so we don't have to kill each other just to get something to eat.
Now, in a private moment, Toll delivers a surprisingly philosophical take on money. He's frustrated with the head of sales and trading's remorse over the day's carnage, and he reminds him and us that at the end of the day, it's just money. And CEOs are the best salespeople. That's why they made it to CEO. And all the billions at stake are made up, just pieces of paper or digits on a screen that we humans agreed to have assigned value to. Why? So we don't have to kill each other to get something to eat. And that stark line, brilliant writing, eh? That stark line traces the origin of money. Instead of fighting or stealing to survive, society created money as a medium of exchange. And this clip is eye-opening for anybody learning finance. It really strips down the idea of money to its basics. A shared fiction or social contract that keeps civilization running. Now, Tull's tone here is almost cynically comforting. He's implying that what they did, meaning the ruthless selling, isn't personal or truly evil, because everything in this business is part of a pretend game that we all play. And this does not justify wrongdoing, but it shows how he rationalizes the damage. To him, money is not moral or immoral, it's just a tool. And the CEO convinced the head of sales and trading to sell the crappy assets.
And the decision has been made to unwind a considerable portion of the firm's holdings in several key asset classes.
Now, unwinding a position means selling off or closing out an investment. Now, a position is just the amount of a particular asset that the firm holds. In this case, they're huge holdings of mortgage securities. So the head of sales and trading is saying the firm has decided to start unwinding their big investment. And he's using careful language, you can tell. But essentially, he's saying we're going to get rid of our huge stake in those assets. And it's a calm word for a frantic task, selling everything before it's too late. And asset classes are categories of investments. Common asset classes include stocks, meaning equities, bonds, meaning fixed income, real estate, etc.
This is what the beginning of a fire sale looks like. I want you to hit every bite you can find. And no swaps. It's outgoing only today.
So a fire sale, of course, means selling assets quickly at extremely discounted prices, usually in a panic or an emergency. And he addresses the team with this stark image. Now, in a normal sale, you'd wait for good prices, of course. But in a fire sale, you accept rock bottom prices just to unload this stuff fast. And he's warning them, we're about to sell everything for whatever we can get, and it's going to be hectic. Now, for context, the beginning of a fire sale is the opening bell, where they'll start dumping their securities at any price buyers will take. And he doesn't mince words here. This is a frantic sell-off. And notice he said no swaps. Now, in finance, swaps are usually derivative contracts where two parties exchange financial obligations, like swapping interest rates or other assets. But here he likely means no swap trades, no buying anything in return, just sell the stuff. Outgoing only, meaning they're only selling assets, not acquiring new ones or making two-way trades. And swaps can also refer to credit default swaps, meaning insurance-like contracts or any fancy trade. And he's shutting all that down for the day. So for our purposes, no swap means no side deals or exchanges, just straightforward liquidation. It's a one-way street today. Assets flow out, cash comes in.
You've got to come out of the gate storming. 40% done by 10:15. By 11 o'clock, all your trades have to be gone because by lunchtime, word's going to be out. And by 2 o'clock, you're going to be selling at 65 cents on the dollar.
Now, he predicts what will happen if they delay. 65 cents on the dollar means that for each $1 in asset value, they only get 65 pennies if they sell, meaning a 35% loss. And he's saying that by 2 p.m., the word will be out in the market that they're selling junk, so prices will crash even further. Now, in plain terms, the longer they wait, the less money they'll get for these assets. And it really highlights how quickly value can evaporate in a crisis. And it's a race against time because the market completely figures out what they're going to be offloading over time. Now, let's talk about grading of the movie for Wall Street Realism with a buy, hold, or sell rating. Now, through these clips, we learned about major financial terms and concepts that drove Margin Call's drama that day. It all took place in one day. And we saw how risk management acts as a company's financial safety net and why slashing it is disastrous. And we learned about volatility as the wild market swings that can break models like value at risk, meaning VAR, which estimates potential losses. And the film really showed us the perils of leverage, meaning borrowing too much based on false confidence in safe assets, and how those mortgage-backed securities turned out far riskier than we assumed. And we heard about exposure, meaning how deep you're in the danger zone, and market capitalization, meaning a company's total stock value being wiped out by losses. What's the response? Well, an extreme fire sale liquidation, dumping assets for pennies on the dollar, while regulators like the SEC circle them like sharks. Now, importantly, even though the term margin call is not spoken in the movie, it's in the title and it's a crucial concept to know. A margin call happens when a broker demands an investor add funds because the value of their leveraged investment fell too much. In essence, it's a financial red alert. Put up more money or your positions will be sold off. And the entire movie is an extended metaphorical margin call. The firm realizes it must immediately cover its losses by selling assets or face total ruin. And in the end, margin call teaches us lessons beyond the plot. We have to manage risk carefully. We have to be wary of too much leverage, and we really have to understand that behind all complex terms, from asset-backed securities to swaps, it's ultimately about money and trust. Now, as CEO John Told cynically notes, money is made up, but losing huge sums of money has very real consequences. Now, hopefully this breakdown helped demystify the finance lingo and gave you a clearer picture of both the film and the financial world. Now, this is by far the most underrated finance movie ever. It's incredibly accurate with brilliant acting. As a result, I'm going to give this movie a buy rating. Now, please comment and subscribe and like, and I will see you in my next reaction video when I react to my favorite movie about 2008, which is called Too Big to Fail. Thank you.